Well, hello again. Sorry about that. As you can see, this is a well-oiled professional machine here. We're just absolutely on top of things. But as I said before, apparently I was sideways, so sorry about that. Facebook's new settings have rejected our camera, so we've had to go back to the iPhone, which is apparently working. So thanks for joining me. It's great to be back in the office. As you know, I've been off for a couple of weeks, looking after my wife Deb, which I'll, for those who are interested, I'll give some more details about what's been going on in the overview on Saturday. But suffice to say that she is on the mend, which is good, and I'll be back on the ABC next week, I expect. I'll probably write a column for The Australian tonight as well. So I'm expecting to be gradually easing back into work and starting with today's Facebook live stream. It's great to see you there. Remember, the live stream and my answers are general advice only. It may not be appropriate for you, not personal advice. So please, if you've got any questions as we're going along, pop them in and I'll get to them as we're going along. Now, just before we get into the questions, I just wanted to remind you, in case you don't know already, about the fact that we've got an event in Sydney coming up. And we're just adjusting the lighting here. But we've got, we had an event in Melbourne a few weeks ago, which went quite well, so we decided we'd better do one in Sydney. And we'll do one elsewhere in the country too, if you're not in Sydney or Melbourne. But starting with Sydney on May the 1st, it'll go from 6:30 till 7, and it's at Stone and Chalk, which is at 11 York Street in Sydney, level 4. As with Melbourne, the tickets are $25 for members, $50 for non-members. So that's really just to cover costs. And we don't expect to want to make money out of it. It's really just about meeting you and providing you with some live guidance and interesting content. So we'll have a panel, and the name of the event, the description or the description of the event is Investing in Disruption. But of course, we'll talk about anything you want to. I mean, we'll answer any questions you might have. And to deal with disruption, we've got Alex Pollock, the CEO of Loftus Peak and former journalist, doing quite well he is, and he's a specialist disruption investor through his fund, which is performing fantastically well. And he'll talk about that on the day. But we've also got Jo Masters, who's the senior economist at ANZ Research, so she can answer questions about the economy, either the Australian economy or the world economy, and I'll be on the panel as well, and I'll answer questions about anything at all, even stuff I don't know anything about. And the moderator will be my friend Emma Alberici, the ABC's economics correspondent, who has been in the news lately, you might have seen, and attracting a bit of controversy herself. But she's a terrific journalist, and I'm delighted that she's agreed to moderate the panel. So should be a good night with Alex, Jo, Joanne, and Emma and me. So love to see you to come along if you're in Sydney. So you'll find a link on the homepage, and Greg will put a link at the on the video that's below the video on the Facebook page here. Oh, and also thanks to Stone and Chalk, who are sponsoring the event by letting us be there for not much to help us with the costs. Let's get into the questions now. Appropriately enough, our first question is about Facebook, which has been causing a problem. One of the things about the Constant Investor is that we do stuff on Facebook, which is one of the reasons we call it constant, because Facebook's going all the time. Now, Des says, I can't help wondering whether you might agree that Facebook has been permanently compromised by its recently revealed breaches of the privacy of its subscribers. Having not much to hide, I don't care so much about my privacy, but I do care about being exploited, even without my knowing it, by men who like to think that they're exploiting me as what I really want. I think that Facebook should be shut down, but I cannot see how the Australian or any government could do that. What do you think? Yeah, I agree, Des. I don't think they're going to be shut down by a government. I do think they're going to be regulated more. The argument that's going on with Facebook has to do with subscription versus free, really. When it comes down to it, fundamentally, it's about what you get and what you're giving up if you use a platform or a product that's free, because obviously nothing's free. There's no such thing as a free lunch. And so with Facebook and all other free products, they're selling your details, they're selling you to advertisers. Now with Facebook, it's a bit different to, say, The Guardian or other free newspaper or content providers, because they know much more about you. And so there's a great temptation, because they know a lot about you, because you put all your life on Facebook, there's a temptation for them to make more money by selling much more targeted advertising to advertisers. Advertisers are able to target very specifically, and that's been the great benefit of Facebook, but it actually leads to a breach of privacy, and I think that they've crossed the line. And it's very interesting. I think that a lot of what the problem has been is where the data was used not so much to make money for Facebook, but to get Donald Trump elected, and that's what people are really, really complaining about. And that's where they seem to have crossed the line. But it's often said, and it's true, that if you're not paying, then the product is probably you, not the thing you're reading or using. And that's the case. That is the case with Facebook. You're the product. But look, anyway, as to whether it'll be shut down, I don't think so. I think that this storm will blow over. There'll be new regulations. Facebook will get its act together, and it'll set about making money, but it might make a bit less money than it was going to make, because it's going to have to be more limited in what the amount of information that it provides advertisers. But I think that the proposition, the fundamental proposition of Facebook and other free providers such as Twitter and Instagram, Snapchat, all those things, the fundamental proposition of using them for free in return for advertisers getting access to you, I think is, as old as TV and radio, and I don't think that's going to stop. It just happens that, unlike with TV and radio, they know more about you, and they're providing more details. They're just going to have to be stopped. So that's what I reckon. I mean, I think we'll keep using Facebook, even though they've blocked my bloody camera. Anyway, we'll forgive them for that if they let us. We'll have to do something to get our camera working again. Jay says, I hope you had a good break. Well, actually, Jay, it was a terrible break. It wasn't a break at all. But let's move that. Let's pass. Move that. Let that pass. Could you please let me know what is your take on THC? THC being not the active ingredient of cannabis, but the company, the hydroponics company. The CEO that was interviewed is David Radford. Who was interviewed on TCI is not there anymore, and the share price is going down. Any insight into the inner workings would be much appreciated. I don't have any insights at this point. I will contact them and see if I can interview them, presumably the chairman now, because they haven't got a CEO anymore. It's interesting that the CEO quit, and the chief commercial officer, whatever he did, quit on successive days. The chief commercial officer one day, and then David Radford, the CEO, the next day. So I'd say they're in a bit of strife, I guess. Well, let's find out. We'll have to find out what's going on. So watch this space. Jay, I hope I get to them. Hopefully the chairman or somebody will tell us what's going on. Sandra says, hi, Alan. On the dividend imputation, ASX is a high-income market, around 4.5% according to Catherine Robson. Some of that must be due to dividend imputation. If I lose the DI, I have lost much incentive to invest here. I can invest overseas where growth is better. Interest rates are going up, outlook is up. I also pay tax there, 15%. Implications of what is proposed are much greater here, I would have thought, than just the DI credit. It's a disincentive to invest in Australia. It may have a farther-ranging impact on the stock market than one would first think. What are your thoughts on this? Yeah, I agree, Sandra. I think that I mean, look, they're not proposing, the Labor Party's not proposing to get rid of dividend imputation entirely. They're just proposing to limit it to the removal or the reduction of existing tax and not any longer pay cash refunds to those who pay less tax than the company tax rate. I mean, that is going to cut it out for a lot of people, and it's going to make dividend imputation, or rather when the Labor Party comes to power, it will make dividend imputation a lot less attractive, and it will make investing overseas more appealing. That is true. That is what's going to happen, and I think it will have an impact on the stock market. And so if you think that the Labor Party is going to win the election, and I do, I mean, you'd have to say they will at this point, unless the Liberal Party does something pretty special, then I think that you would want to, if you think that's going to happen, you would want to lighten off your holdings of some of those stocks that benefit from dividend imputation, like the banks and the other high franked yield paying stocks. It might also lead to more investment in the REITs, the staple securities that don't pay franked dividends, and others that don't pay franked dividends. I mean, companies like CSL is like investing overseas because so much of their revenue comes from overseas, and therefore the dividends are not franked. And so basically, I think you're right, Sandra. That's going to mean that 100% franking is going to be less appealing. Not unappealing entirely, but a bit less appealing than it was. Duncan says, does anyone know of an actively managed ETF or LIC that focuses just on US tech stocks, looking for an alternative to a passive US tech ETF? Well, the two that I like, that I would mention to you, are Alex Pollock's Loftus Peak and Nick Griffin's Munro Partners. So they're the ones I know. I don't think that they're the only ones, obviously. I think Elliston does quite a lot of investing in Elliston Global, is an actively managed LIC that invests in global companies, but not just tech stocks. Whereas Munro Partners and of Loftus Peak specialise in technology. David says, what do you plan to do regarding the Blue Sky Alternative Investments Fund? And there's another question on this from John. Hi, Alan. Just wondered if you had any comments about the Blue Sky saga. Noticed you hold some. It seems to me that this US broker is correct, that if this US broker is correct, then quite a lot of our brokers really haven't been terribly diligent. On the other hand, if the accusations turn out to be mischievous, then surely it's a screaming buy. Yeah, well, my plans, so yes, I do hold some. I've been a supporter of Blue Sky in general. I think that I've always thought they're a pretty good business and an ethical business, I have thought. I haven't read it's Glaucus Research. It's not a broker, it's a hedge fund called Glaucus Research. They first came to prominence in Australia when they shorted and attacked Quintus and got it absolutely right. They were right about Quintus and they made a lot of money. The thing went broke in the end. So I do think that they have to be paid attention to. They certainly can't be dismissed out of hand. And I don't know that Blue Sky's and Rob Shand at Blue Sky have really handled it that well so far. I mean, I haven't read the entire paperwork that Glaucus has put out on Blue Sky. I just haven't had a chance. I've noticed it going on in the background, and I'm thinking I must have a look at this. And so I haven't read that. I note that Blue Sky have responded. I note that the share price has fallen, and also now that Glaucus this morning has put out a statement responding to Blue Sky's response and hopping right into them again. So my plan with this is to interview both sides and then to come to a conclusion. I can't really come to a conclusion until I've spoken to them. So I'll read the Glaucus research material. I'll interview Rob Shand and I'll put the issues to him. and I'll also interview, I hope, the person from Glaucus, who I interviewed last year in relation to, or was it, no, it was actually 2016, I think, yeah, so 18 months ago I interviewed this bloke from Glaucus when he first went after Quintus, or before actually. He came to Australia and said he had two stocks in his sights, that's right. So that was 2016, and he told me that he had two companies in his sights in Australia. Turned out fairly quickly after that Quintus was number one, and that came off, and obviously Blue Sky is number two, and here it is. So I'll try to get him back on, and then I'll come to a conclusion of my own, and I'll either sell my shares and tell you about that, or I'll buy some, I guess. We'll see how it goes. So that's all I can say at this stage. I mean, just watch this space. I'll be, hopefully, I've put in a bid for both of those interviews. I hope to interview Rob Shand from Blue Sky tomorrow, and I don't know about Glaucus, whether or when I can get them. Dan says, in the light of the Santos takeover bid, is it better to sell on the rumour of a takeover and take, say, 30% in 1 year's profit, or to hold and risk it, sliding back to or below the cost base in the short term? It's an area I'm trying to improve on and find it difficult, challenging to negotiate. The rumours of a Vocus takeover last year sent the shares soaring by a similar amount, but failed to follow through. And a while ago, holding IINet was fantastic, but acquiring TPG not so great. My sense is that it's better to sell on the market move and be done with it, but requires more resilience to do so. What are your thoughts? Yeah, it's very interesting, Dan. I mean, my friend Tom Elliott, who is a takeover specialist, takeover investor, he invests in takeovers. What he does is he buys when the first takeover is announced, or that's been his strategy over a long time. So he buys in the knowledge that most of the time, not all the time, but most of the time, the final price ends up higher than the initial price. And once a takeover is announced, your downside is limited. So from his point of view, he reckons that you are, by buying at that point, you limit your downside. In fact, your downside is virtually zero, and you almost always get some upside, but not always. So what you're talking about is selling when it's first announced, because some of the time it goes up, not all the time. And anyway, you're getting most of your gain at that point, and that's true. I think you need to distinguish between the rumour of a takeover and the fact of a takeover. So I'd be careful about that. I mean, I think there's quite a clear difference. With Santos, the initial rumour was just a rumour, and now it's come off. There is one now. I think the Focus thing, there was a rumour and it wasn't true. So I think you need to be careful. I mean, if the shares go up and it's a rumour and you're happy with the price, then take it, I reckon. I think you're onto something there. And if we're talking about a big spike in the price on the rumour of a takeover, and you're happy with the price that you're getting, then that's probably a good time to sell. But I mean, just be aware that you're possibly leaving some money on the table, because you never know what the takeover could end up being higher than the market is anticipating. But then again, it could be lower. So I don't have much more to add on that. I mean, I think that takeovers are a kind of an interesting and usually rewarding basis on which to sell. I mean, it's great, to be honest. Matthew says, hi Alan, wondering if you could explain the fall of Afterpay recently. Is it a case of the Trump factor spooking the tech sector, or an issue with the maturing executive stock in May, or both? It appears their last earnings guidance was great. Then after that, it's gone to doo-doo. It has indeed gone to doo-doo. There's another question on a similar lines from Jignesh. Hi Alan, is there any reason why LVH share price is dropping? If not, do you see it as a buy opportunity? LVH stands for Live Hire. So Yes, we're seeing both Afterpay and Live Hire share prices falling. I don't think it's a Trump factor, but I do think what's going on here is the market globally, not just Australia, but globally, is repricing, rethinking companies that burn cash. And that goes for some of the big ones too, Facebook. They're not burning cash, I don't think, but a lot of them are. A lot of these big tech stocks still are, even though they're making an absolute fortune. They're spending an even bigger fortune. Both Afterpay and Live Hire are still burning cash. I can't remember how much exactly, but you can easily find out on the website. Both of them are growing rapidly. They've both got good businesses, and their share prices, ran really hard. So the market, even though they were losing money, the market put a big price on each of them based on an expectation of what they might make in the future. And I think that what's going on now is that around the world, with a lot of these stocks that are losing money, going for sort of a land grab for the future, trying to build market share, the market's having another think about that and repricing them. I think it doesn't change the fact that you still have to look at the business and make an assessment of whether you think the business is any good. It's just very hard to value companies that lose money. If they're making money, you can easily value them on a PE basis or a yield, perhaps if they're paying a dividend. Companies that are making money, you can just use traditional valuation methods. Companies that are losing money, it's a guess, really. That is speculation in a way. I mean, it's not quite as speculative as, a mineral stock, for example, that, is putting a drill hole down and may or may not find gold or nickel. Because in each case, with Afterpay and Life Hire, they clearly have a real business here. Just a question of how big it's going to be, and is it going to be global, and what's the size of the opportunity. So the question is, with each of them, is it worth 50 million or 100 million or 200 million? Because those are the numbers we're talking about with their market capitalisation. And I think what's going on now is the market is kind of saying, okay, well, we're just going to reprice those prospects, and we're not that happy as we have been with cash burn. My view at some point, because these are decent businesses, they probably are a buying opportunity. But as with all of them, until they're making money, they're a punt. That's for sure. Final question from Robert. Alan, what are your thoughts on the RBA holding rates at 1.5% indefinitely for the foreseeable future? What do you think this signals about the current state of the Australian economy? To be honest, Robert, I've written this. I think it's great. I think that an economy that's going along at 2.5% to 3%, which is what the Australian economy is doing, with very little inflation and interest rates not doing anything. I mean, there's been 18 meetings in a row with the interest rate at 1.5%, and I had spoke to Joe Masters this morning of ANZ for tomorrow's Talking Finance. She reckons that, and they reckon at ANZ, that the rate will be 1.5% this time next year, so another 12 months. And then only 2 rate hikes in 2019. So the fact that the RBA is doing nothing, I think, is fine. It means that, there's neither a recession nor a boom. Recessions tend to be caused by booms. So if you don't have a boom, you won't have a recession. And as an investor, I think we should be celebrating the fact that the economy is growing, chugging along at 2.5% to 3%. That's fine. That means we can relax a bit. Sure, it's not it's not great that the wages aren't growing, and I think that retail sales are pretty sluggish. Growing at 3%, possibly even less, 2%. So, I think that there are. It's not. I'm not saying it's fantastic, but I think we do need to get used to the idea that we don't have booms and busts, or we don't want booms and busts. You know, we don't want retail sales growing at 6 to 10% per annum and then suddenly slumping to minus something. I mean, if we can get a soft landing in the property market, which is what seems to be happening, then I think it's great. So that's my thought. What it signals about the current state of the Australian economy is it's just chugging along. It's mediocre. It's not booming, and that means we're less likely to have a recession. So today, for the rest of the day, we've got the Money Cafe, which will come out tonight. I'm going to go off and talk to Kirby now. Haven't seen him for a few weeks, so it'll be great to catch up with James. And don't forget the Sydney event. Have a look on the Facebook page or the website for tickets. Love to see you there. Thanks, and I'll talk to you next week.